Hello and welcome back to Bhavani JIIB. Today we are talking about retail banking specially made for Indian bank employees aiming to crack JIIB. In our journey through paper 4 module D, we start with 24th unit investment management. Here we will be learning about the introduction, the elements of investment management, the steps in investment management, roles of investment management, services offered by investment banks, the IB structure, portfolio management, objectives and key elements, types of portfolio management, advantages and disadvantages. So, what is investment management? Today's topic is very practical. In simple words, management means managing money to meet future financial goals like retirement, child's education, or buying a home. For example, someone has 10 lakh rupees. Investment management helps them to decide whether to put it in mutual funds, bonds, or real estate based on their goals and risk levels. So, the elements of investment consists of returns, that is the gain from your investment, risk, the chance of losing your money, safety, will your money be secure, that is getting back your money safely, liquidity, can you convert it to cash easily? The ability to convert investment into cash easily is liquidity. So these are the four elements of investment management. So it also involves buying and selling assets like stocks, bonds, and mutual funds, like I had earlier told you. A savings account is safe and liquid, but return is very low. But stocks have higher returns but more risk. So these are the different elements that are there in investment banking. Next, we will be looking at the steps in investment management. There are five clear steps. One is to define your goals or to decide your goals. Next is to analyze the particular goals or to study the different investments. Then you build a portfolio. That is, you create a portfolio, a mixture of all the investments. Next, you will check the performance of those investments. That is, you will track the returns and then you will make necessary changes whenever it is required. That is, you will be updating the portfolio. For example, a 30-year-old planning for retirement may invest more in equity now and shift to debt later. This is about steps in investment management. Roles of investment banking. So, before we look into the roles of investment banking, we learn what is investment banking. This is not the same as investment management. Investment banking means helping companies to raise money or to do big financial deals. For example, when Zomato launched its IPO, it took help from investment banks like Morgan Stanley and Kotak. So, this is investment banking. The roles of investment banking include raise money for companies and governments, to underwrite, that is, guarantee new shares and bond issues. It helps in mergers, acquisitions, and financial restructuring. It advises on big financial deals. That is, it advises large businesses on on financial deals. This is about roles of investment banking. Services offered by investment banks. Let's list them simply. The first one is underwriting. It helps companies to raise funds. M&A advisory. It manages big corporate deals. M&A is merger and acquisition actually. Sales and trading. Trading services which includes buying and selling of shares. Equity research. It involves study of the stock performance. The stocks, how are they performing? So that is the equity research. Asset management. It manages investments for the clients. We'll mainly look at what what do you mean by underwriting, like types of underwriting. There is firm commitment, best efforts, and all or none. So, what is firm commitment? Bank buys full share issue. That is firm commitment. Best efforts is bank tries to sell but doesn't promise. Okay, so bank tries to sell, returns unsold. So it means it doesn't promise you that it is going to sell it for sure. All or none. If not fully sold, the deal gets cancelled. So if not fully sold, deal is cancelled. Either it sells it or it doesn't sell. So that is all or none principle. So here we will take an example. If a company wants 100 crore rupees, the bank may agree to underwrite full 100 crores or just try its best. So either you buy it completely or you try your best to sell it, or you will either sell it or you don't sell it. So these are the three types of underwriting. Next, we'll move to the investment bank structure. As you can see here, we have the front office, middle office, and the back office. In the front office, we have the client facing roles like sales, trading, research, asset management, etc. Middle office includes risk and treasury functions. It includes risk management and treasury functions. The back office consists of operations and technology, administration, accounting, human resources. So, all these things are included in the back office. Think of front office as salespeople and the middle as analysts and back as support staff. So, this is about it. This is the investment bank structure. Before we look into the portfolio management, I'll just explain what is the difference between investment management and investment banking. See, investment management invests your money, but investment banking helps you raise that money. Investment management is on the buy side, while as the investment banking is on the sell side. You have to imagine this example. One helps you to grow your savings, the other helps a business raise their capital. So that is the difference between investment management and investment banking. Next, we'll move on to the portfolio management. This is a core part of investment management. It means managing a mix of investment to meet a specific goal. It's the art of managing investment to achieve specific goals, and it includes assets like shares, bonds, cash, mutual funds, etc. A working professional may invest 60% in equity and 40% in debt to balance risk and return. Okay, portfolio manager helps choose the best options based on income, risk capacity, and the time horizon. That is, if you're young, there'll be a different type of portfolio management, and if you're in the middle age, you have a different one, and uh, if you're in the old age, there will be a different portfolio management. So this is about portfolio management. So what are the objectives of portfolio management? Increased returns. That is, you maximize the returns, you minimize the risk. You diversify the investments. That is, you make the best use of the resources and flexible and diversified portfolio. And you're making better use of the funds of all the resources, and you protect the long-term capitals. That is, you're protecting the long-term capitals. This is about the objectives of portfolio management. So, if we have to, before we go into the key elements of portfolio management, who needs portfolio management? See, the simple answer is people who don't understand markets are the ones who need portfolio management, the busy professionals, and those who want expert advice. So, these are the three kinds of people who require the portfolio management. For example, a doctor with no time to track stocks may hire a portfolio manager to manage his 25 lakh investment. So, this is how it usually works. So, the key elements of portfolio management includes asset allocation. That is, how much in equity, how much in debt, how much in gold, etc. So this is asset allocation. How much are you allocating in each asset? Diversification, not putting all money in one asset. We are only looking at few of the key elements here. So this is asset allocation, diversification, and rebalancing. Rebalancing means adjusting the mix based on the market or life events. So based on that, you will be changing your mix, right? So you might need money for some medical emergency, or the market might have gone down. So based on that, your mix also will keep changing. Your portfolio management will change. So this is about the key elements of portfolio management and also the objectives. So before we go into the types of portfolio management, we look at what is the difference between portfolio management and investment banking. We just now looked at the investment banking, right? So we are trying to differentiate between portfolio management and investment banking. Portfolio manager, portfolio management is, it manages the wealth, but investment banking raises the wealth. So these are the two things that you need to keep in your mind. We look at the types of portfolio management. It includes active, passive, discretionary, and non-discretionary. Active includes buy or sell actively for more returns, but passive includes track an index like Nifty. That is, you are simply investing and you're just tracking from the background. So you're not buying or selling very actively. Discretionary is manager takes all the decisions. So you don't get to make any decision. The manager takes all decisions. Non-discriminatory is where the client approves every action. So the client tells you what the manager has to do. So that is non-discretionary. So these are the four types of portfolio management. Next, we will move to the advantages and the disadvantages of portfolio management. It helps pick the right assets. Okay, and it maximizes the returns. It reduces the investment risk. It tracks the performance of your investments, and it manages the liquidity, and it improves your financial knowledge. So this is about the advantages of the portfolio management. So, but what are the disadvantages? Over diversification on risk. So too much diversification can reduce your returns sometimes. So may not protect from big market crashes. So it cannot protect you from a very major market crash. Wrong decisions if old or poor quality data is used. So wrong forecasts are possible with outdated data. Okay, so your data should be updated always. So this is about the disadvantages of portfolio management. Investment management is not just about where to invest. It's about why, when, and how much to invest. So far, we have learned the introduction elements, the steps in investment management, the roles of investment banking, the services offered by investment banking, IB structure, portfolio management, its objectives and key elements, the types of portfolio management, its advantages and disadvantages. So there are three types that you need to remember here. So go through this chapter properly. And don't forget to subscribe for more insights into the world of banking. Stay tuned, stay informed, and keep banking the Bhavani JAIIB way. Thank you. And next up, we will be learning the next unit, tax planning. Until next time, happy banking.